Most crypto price movements that look sudden or irrational are neither random nor accidental. They are the result of incentives aligning, behavior repeating, and liquidity reacting faster than human judgment. The common belief is that pumps are driven by good news and dumps by bad news. That story is comforting because it suggests prices move for understandable reasons. In reality, news usually follows price, not the other way around, and by the time a headline appears, the market has often already decided. Another misconception is that a single group controls every move. While manipulation does exist, most large price swings are not caused by one actor pulling a lever. They emerge from many independent decisions, interacting inside a fragile market structure. At the center of crypto pumps and dumps is liquidity. Liquidity determines how much capital is required to move price. And in many crypto markets, that amount is surprisingly small. When buy or sell pressure exceeds available liquidity, price must jump to find the next willing participant. This creates an environment where momentum matters more than fundamentals in the short term. Once price begins moving, it attracts attention, and attention brings more orders. Those orders push price further, not because value has changed, but because participation has. Psychology amplifies this effect. Humans are highly sensitive to rapid change, especially when money is involved. A rising price triggers FOMO, while a falling price triggers fear of loss. And both emotions compress decision-making time. As more people react emotionally, the market becomes reflexive. Price movement changes behavior, and behavior feeds back into price movement. This feedback loop is what turns a normal fluctuation into a pump, or a healthy pullback into a dump. Leverage quietly accelerates the process. When traders borrow capital, they introduce forced decision points into the system. Liquidations are automatic, not thoughtful, and they turn gradual moves into sharp cascades. In a rising market, leverage fuels upside by forcing short positions to close. In a falling market, it does the opposite, forcing long positions to sell, regardless of conviction. This mechanical pressure explains why moves often overshoot in both directions. Timing also plays a critical role. Many large price movements occur during periods of low participation, when fewer orders are available to absorb pressure. Thin markets exaggerate every action, making modest decisions look dramatic. What often gets overlooked is that dumps are not always signs of failure. They are frequently the release of built-up imbalance after speculation outruns liquidity. Without these resets, markets become increasingly unstable. The mistake many participants make is assuming intent where structure is enough to explain the outcome. Not every dump is an exit by insiders, and not every pump is coordinated promotion. Sometimes, the market is simply correcting its own tension. There are patterns worth paying attention to. Sharp moves that occur with little participation tend to reverse just as quickly. Moves that unfold slowly, with steady engagement, are usually more durable. Another signal is emotional language dominating decision-making. When certainty replaces analysis and urgency replaces patience, risk increases. Markets are most dangerous when people stop questioning the move and start justifying it. It is also important to recognize when you are reacting rather than deciding. If your motivation is fear, either of missing out or losing what you have, the market is already in control. Pumps and dumps thrive on rushed behavior. The reality is that crypto markets are still young, fragmented, and highly sensitive. That sensitivity makes them volatile, but also predictable in their patterns. Understanding structure and psychology matters far more than chasing explanations. Crypto pumps and dumps are not mysteries waiting to be exposed. They are the natural outcome of thin liquidity, leveraged positioning, and human behavior interacting at high speed. Once you see that clearly, price movements stop feeling chaotic and start making sense. If this explanation helped, subscribe for more clear breakdowns like this. Thanks for watching.